When beginning a company, there are several sorts of business ownership structures that you may pick from. Each has its merits and downsides, mainly relating to tax arrangements and liabilities. We take a deeper look at each ownership structure to help you identify which is the best for your new firm. The 6 most frequent forms of company ownership are as follows. 1. The cost savings of a sole proprietorship. A sole proprietorship is an unincorporated business entity that is owned by a single individual. This organizational setup is typical for many smaller groups that like to keep things simple. Typically, a sole proprietorship does not have a separate legal organization, although an LLC or S corporation may be created for that purpose. 2. General partnership. Best for new partners. If you and one or more other people choose to run a business together and split the gains and the losses, you have formed a general partnership. Each partner in a general partnership must file their own tax return depending on their share of the partnership's income. Partners have full responsibility for any debts and legal obligations incurred by the business. The best liability structure is a limited liability company, LLC. 3. A limited liability corporation, LLC, is a business structure that restricts the personal responsibility of LLC members. After registering with the Secretary of State in the state where the firm will be based and operating, the limited liability company, LLC, is considered a legal entity in that jurisdiction. Members' personal assets are protected by the LLC's limited liability, so only business assets are subject to creditors' claims. Members can't be held personally liable for them. LLPs, limited liability partnerships, are ideal for corporations in the professional services sector. As a commercial entity, a limited liability partnership, LLP, limits the responsibility of its participants to the amount they have invested. The risk for the firm is divided among the partners who each have specified positions in the enterprise. Because liability is restricted, creditors cannot go after partners' personal assets for business debts and obligations. 5 reasons why AC Corp is ideal for raising capital from the outside. AC Corporation is a commercial entity that is set up with stockholders as the proprietors of the firm. The assets of shareholders are not in danger since their responsibility is limited to the company's debts. For tax purposes, AC Corporation is treated independently from its shareholders, unlike a limited liability company, LLC, which distributes its profits to its owners. This may result in double taxation if the business is taxed and then the owners are taxed when distributions of earnings are made to them. S corporations are ideal for businesses with several owners that want to be governed by a board. Similar to C corporations, S corp form legal entities, issue stock to investors, and have top-level management in the form of a board of directors. An S corporation is unlike a C corporation in that it may choose to have its profits distributed to its shareholders. This prevents the potential of double taxes as a company. When you're just getting started in a company, you could feel overwhelmed by the sheer number of options accessible to you. Take the time to analyze what you want for liability structure, tax structure, and how flexible you want ownership to be. Here are the main points to remember and the distinctions between the various entity kinds.